Spotify's stock just took a nosedive, a dramatic plunge that has investors reeling and analysts scrambling to understand the underlying causes. The streaming giant, once a darling of the tech world, is now facing serious scrutiny. Over 15% in a single day. A staggering drop that reflects deep concerns about the company's future performance and its ability to meet increasingly high expectations. This kind of volatility can shake even the most seasoned investors. After its Q3 2024 results disappointed Wall Street, the numbers simply didn't live up to the hype, and the market reacted swiftly and decisively, sending a clear message to Spotify's leadership. Billions in market value vanished, wiped away in a single trading session, leaving a trail of red ink and anxious shareholders in its wake. The sheer scale of the loss is a stark reminder of the risks inherent in the stock market, leaving investors questioning what went wrong for the streaming giant. Was it a temporary setback, or a sign of deeper, more systemic problems within the company's business model? The uncertainty is palpable. The culprit? What factors contributed to this dramatic downturn, and what can Spotify do to turn things around? Let's delve into the details. Spotify missed revenue expectations, falling short of the targets that had been set by analysts and the company itself. This immediately raised red flags about the company's ability to generate income, and issued a weak forecast for the next quarter, painting a bleak picture of the immediate future and further eroding investor confidence. The projections suggest that the challenges are likely to persist, signaling ongoing challenges. These headwinds include increased competition, evolving consumer preferences, and the ever-present pressure to innovate and stay ahead of the curve in the fast-paced world of streaming. While user numbers keep climbing, showing that Spotify is still attracting new listeners and maintaining its position as a leading platform, this growth isn't translating into increased profitability. The company isn't making as much money from them as analysts hoped. The revenue per user metric is a key indicator of financial health, and its decline is a major cause for concern. Investors are now demanding more than just growth. They are looking for concrete evidence that Spotify can effectively monetize its user base and generate sustainable profits. They want proof Spotify can turn its massive audience into real profits. The pressure is mounting to demonstrate a clear path to profitability and long-term financial stability. Years of prioritizing expansion over earnings, focusing on acquiring new users and expanding into new markets, have left the company vulnerable to market shifts and investor skepticism, have tested the market's patience. The honeymoon period is over, and investors are now demanding tangible results and a clear return on their investment. The focus has shifted, the rules of the game have changed, and Spotify needs to adapt quickly to survive and thrive in this new environment. It's no longer about how many people use Spotify. While user growth remains important, it's no longer the sole metric by which the company is judged, but how much money each user brings in. This is the key to unlocking sustainable profitability and restoring investor confidence. The pressure is on for Spotify to demonstrate that it can not only attract users, but also effectively monetize them and generate consistent profits. To prove its business model can deliver sustainable financial success, the road ahead will require strategic decision-making, innovative solutions, and a relentless focus on profitability. Before earnings, analysts predicted Spotify would report about €3.95 billion in revenue for Q3 2024. The actual number? €3.85 billion, a €100 million shortfall that sent alarm bells ringing. Even though Spotify posted a slightly better than expected operating profit, the revenue miss overshadowed any good news. Wall Street cares most about top-line growth, especially for tech companies. The improved profit was seen as a temporary fix, not a long-term solution. Investors want to see a business that's expanding and capturing more market share, not just cutting costs. The weak revenue and cautious forecast for Q4 made it clear. Spotify's growth engine is sputtering. The market's disappointment was swift and severe. For Spotify, the message is clear. Revenue growth is king, and anything less won't cut it. Spotify's monthly active users hit 651 million in Q3, beating expectations and showing strong global appeal. Growth is coming from both established and emerging markets, thanks to the free ad-supported tier. But here's the catch. Most new users are on the free plan, which brings in far less revenue than paid subscriptions. Adding millions of free listeners looks impressive, but it doesn't automatically boost the bottom line. The real challenge is turning this massive audience into paying customers, or at least increasing the value of each user. Investors are no longer satisfied with just big user numbers. They want to see real monetization. The question now, can Spotify convert popularity into profit? The company's future depends on finding that answer. Premium subscribers are the lifeblood, the financial backbone of Spotify's entire operation. They are the engine that drives revenue and fuels future growth. Without a strong base of paying customers, the entire model would crumble. And the latest figures show their importance more than ever. Q3 saw them reach a staggering 252 million subscribers, right on target, demonstrating consistent growth and solidifying their position in the market. This number reflects the effectiveness of their strategies and the continued appeal of their service. The freemium model, offering a basic service for free while enticing users to upgrade, is still working effectively. It's a well-honed machine that continues to attract new listeners. It's steadily funneling free users into paid plans, converting casual listeners into dedicated subscribers who are willing to pay for an enhanced experience. This conversion rate is a key metric for Spotify's success. Growth comes from several key areas, including expansion into new markets around the globe. Reaching new audiences is crucial for sustained growth. It also relies on creative pricing strategies, designed to appeal to a wide range of potential subscribers. And promotional offers play a significant role, including enticing discounted trials and family plans that cater to different user needs and budgets. These promotions are designed to lower the barrier to entry and encourage signups. But there's a catch, a potential challenge lurking beneath the surface. Many new subscribers are joining in regions with lower prices, where the cost of living is different, or they are opting for discounted plans, impacting the overall revenue picture. This influx of lower-paying subscribers is putting pressure on average revenue per user, or ARPU, a key metric for financial health. So while the subscriber count is undeniably up, showcasing impressive growth and market penetration, the money made from each one isn't growing fast enough to offset the lower prices and discounts. This creates a potential imbalance in the long run. Spotify faces a tricky balancing act, a delicate situation that requires careful consideration and strategic planning. They need to keep growing the subscriber base, attracting new users and expanding their reach into untapped markets, while also simultaneously increasing the value of each subscription, finding ways to generate more revenue from existing users. Investors naturally want to see both quantity, a growing subscriber base that demonstrates market dominance, and quality in subscriber growth, meaning that each new subscriber is contributing meaningfully to the company's bottom line. The company must find innovative ways to boost ARPU, to increase the revenue generated per user, without slowing down user acquisition, without hindering their ability to attract new listeners and expand their market share. That's the next big test, the critical challenge for Spotify's business model as it continues to evolve and adapt to the changing landscape of the music industry. Spotify is reinventing itself as more than just a music app. It's aiming to be the world's audio hub. The AI DJ feature personalizes playlists with a virtual host, making music discovery more engaging. Spotify's push into audiobooks, now bundled for premium users in select markets, challenges rivals like Audible and adds value to subscriptions. Meanwhile, AI-generated music, even entire virtual bands, are popping up on the platform, raising new questions about creativity and royalties. These innovations are designed to keep users engaged and spending more time and money on Spotify. CEO Daniel Ek's vision: capture a bigger share of your audio day, from morning playlists to evening audiobooks. The more time you spend on Spotify, the more valuable you become, whether you're a free or paying user. It's all about deepening engagement to drive long-term growth. Spotify's Q3 revenue was €3.85 billion, with €3.3 billion from premium subscriptions and €550 million from ads. Ad revenue growth slowed, contributing to the revenue miss that rattled investors. On the bright side, Spotify posted a €45 million operating profit, small but a big shift for a company used to losses. Cost-cutting, including layoffs, helped boost profitability, signaling a move toward more disciplined growth. But the biggest expense remains royalties paid to music labels, making it tough to achieve high margins. Even with over 650 million users, Spotify's profits are limited by industry dynamics. The company's healthy cash reserves give it room to invest, but investors want to see that capital turn into real returns. The challenge translates scale into sustainable profits. Spotify's financial story is now about efficiency, not just expansion. Spotify's drive for efficiency led to major layoffs, shrinking its workforce from nearly 10,000 to about 7,500. These cuts helped deliver a rare operating profit, but also marked a shift from rapid expansion to fiscal discipline. The company is now focused on doing more with less, prioritizing projects with clear paths to profitability. Spotify also continued its share buyback program, signaling confidence in its future. But buybacks can't offset weak revenue growth. Investors care more about the fundamentals. The recent stock plunge shows that cost-cutting and financial engineering aren't enough. The real test is whether Spotify can reignite top-line growth. That's what will determine its long-term value. Spotify's Q4 forecast disappointed investors, projecting slower growth in both users and premium subscribers. The company expects to hit 670 million MAUs and 261 million premium subscribers, still growing, but at a decelerating pace. Most concerning revenue guidance of €4 billion fell short of analyst expectations. The weak outlook confirmed fears that revenue challenges aren't just a blip. They're a trend. Even with continued cost controls, profit projections remain conservative. The market punished Spotify for signaling a bumpier road ahead. The message: Spotify must prove it can accelerate growth, not just manage costs. For listeners like you, the evolving landscape at Spotify brings both opportunities and potential drawbacks. It's a time of change, and understanding what these shifts mean for your listening experience is key. Spotify's financial pressures could mean some adjustments to the service as we know it. The company is under pressure to demonstrate profitability, and that often translates to changes that directly impact the user experience. One of the most direct impacts could be higher prices for premium subscriptions. As operational costs rise and the need for profitability intensifies, users may see an increase in their monthly fees. Another potential consequence is an increase in the frequency and intrusiveness of ads for free users. Spotify might lean more heavily on advertising revenue, leading to a less seamless experience for those who don't subscribe. We might also see the introduction of new premium tiers with exclusive features designed to entice users to upgrade. These could include higher quality audio, offline downloads for more devices, or early access to new releases. The company may tighten the free experience to push more users toward paid plans, limiting features or increasing ad frequency to make the premium offering more appealing. Big spending on exclusive podcasts will likely be scaled back, as Spotify reevaluates its content strategy and focuses on areas with the highest potential for return. This means a shift towards content that delivers clear returns on investment, prioritizing data-driven decisions over speculative ventures. Expect more value-added features, like audiobooks and enhanced music discovery tools, to justify future price hikes and keep users engaged. For Spotify, the Q3 stock crash is a wake-up call, a stark reminder that the market demands more than just user growth. Simply put, growth alone isn't enough to satisfy investors or ensure long-term sustainability. The company must now prove it can be both popular and profitable, balancing user satisfaction with financial responsibility. The service will keep evolving. Expect changes in pricing, features, and content strategy as Spotify navigates this new chapter. For investors, the next chapter is about sustainable profits and consistent financial performance, not just user numbers or subscriber growth. The focus is shifting towards long-term value creation. For users, the core experience of accessing a vast library of music and podcasts remains, but the way it's packaged and priced is likely to shift, potentially impacting accessibility and affordability. Ultimately, Spotify's challenge is to turn its global reach and massive user base into lasting financial strength, ensuring its continued success in the competitive streaming landscape.